Good afternoon, audience. Welcome to our April Hot Topics in Compliance webinar. My name is Catherine Baxter. I'm going to be your moderator for today. We have a wonderful webinar for you. I think you're going to really enjoy it. We have some of our resident experts with us today. And before I turn everything over to my host, Vanessa Lowe, I'm going to go over a few housekeeping items. These are our administrative announcements, so turn up the volume on your computer as loud as you need so that you can hear this webinar. If you need to resize these slides, just drag the bottom right corner. From this site, you will need to allow pop-ups. Now, during this webcast, because we're talking about some of your favorite topics, we're anticipating a large volume of questions, so please ask questions throughout the webcast. In fact, once you know your speaker's name, address your question to that speaker, okay? But please ask your questions throughout. The sooner we get your questions, the quicker we can answer them at the end of the webcast. Now, what we're going to do is at the end of the webcast, I'm going to push out a brief survey, as normally. You don't need to watch your email. Just keep watching your screen because you'll fill it out online. And as always, in approximately 3 weeks, we are going to close caption this webinar for on-demand viewing, and it will be available for approximately 1 year, so you can view this as many times as you like. As I mentioned, we have a very exciting webinar today. I think you're going to really enjoy this. I'm going to turn the console over to Vanessa in a moment. Vanessa's going to tell you about the test that you can take and the certificate of training that you can get during this webinar. So without further ado, I'm going to turn this over to Vanessa. Vanessa?
Thank you so much, Catherine. I'm excited to be here. It's been wonderful working with these experts in compliance who we have for you today. So let's move forward. Let's start with our usual disclaimer. Remember that this webinar, like all of our webinars, is offered for informational and educational purposes only. NCUA does not endorse any particular credit union or vendor or their employees, products, or services. All right, let's move forward. Let's talk about what you're going to hear today. So we're going to have somebody from the NCUA Office of Examination and Insurance talk about BSA compliance requirements. Essentially, what are the components of a good BSA program? Next, then, we'll have somebody from NCUA's Office of Consumer Protection talk about two issues, adverse action notices and electronic fund transfers. And then finally, we have a guest from the Maryland DC Credit Union Association. Our expert in compliance from that organization will talk about two things again, suspicious activity reports, or SARs, and money laundering. As Catherine said, you can ask questions throughout the webinar, so please submit them through the little Q&A widget that you'll see at the bottom of your screen. I always like to make sure that you have some faces to go along with the voices that you hear. So there's my face. I'm Vanessa Lowe. I'm an Economic Development Specialist in NCUA's Office of Small Credit Union Initiatives. I've been with NCUA for about 9 years, and before that I was with the U.S. Treasury's Community Development Financial Institutions Fund. We're actually going to talk a little bit more about that particular organization at the end of our webinar. Let me move forward and let's hear from our first guest speaker. Judy.
My name is Judy Graham, and I began my career with NCUA as an examiner in Erie, Pennsylvania, way back in 1998. I'm currently a program officer in the Office of Examination and Insurance, and I concentrate primarily on Bank Secrecy Act issues and also other areas of compliance.
Thank you, Judy. Now let's hear from Galen.
Hi. Hey, my name is Galen Wilkins, and I'm an analyst in the Division of Consumer Compliance Policy and Outreach. It's an office or division under the Office of Consumer Protection. Altogether, I worked about 16 years at NCUA. I started as a technician and then became an examiner, and now I'm an analyst. Currently, I conduct fair lending examinations and supervision contacts in all size credit unions. However, in my past, I also worked in a few small credit unions wearing many hats. This experience, I believe, helps me to understand small credit union operational challenges. And with that, I can offer you reasonable solutions to meet your day-to-day operations and hopefully meet your regulatory requirements.
Thank you, Galen. And now let's hear from Andre.
Hello, my name is Andre Lucas. I am the Director of Compliance with the Maryland and D.C. Credit Union Association. I've been at the association now for 10 years. Started my career in credit unions in 1984 as a collector with Pentagon Federal Credit Union. And in 1986, I was a collection manager at Commonwealth One Federal Credit Union. I stayed there for 20 years.
Thank you, Andre. You'll actually find brief bios, or actually more than what they've been able to talk about because we're on short time, in the resource widget, but also under the bios tab, so you can learn more about our speakers there. Next, let's talk about the certificate that's available. As a participant in our webinar, you can get a certificate of completion. These can be very helpful for your board members, for your volunteers, even new staff. We've built a pretty exhaustive body of webinars over the years. I think we have more than 30 webinars now on various topics. And so we hope that you'll use these, and it's nice to have the certificate to show that you have completed these trainings. So in order to get the certificate, you have to stay on the webinar for at least 45 minutes. You have to answer all 4 poll questions. Now, I know some of you may not be with credit unions, so we always have an NA option, meaning not applicable. And the third piece is you need to take the quiz and get at least 12 out of the 15 quiz questions right. You will find information about the quiz and an update as to how close you are to getting the certificate in the magenta widgets on the bottom of your screen. So that's the certificate. Let's move on, and actually let's do our first poll. We always ask this question, which is, what is your credit union's asset size? It goes from less than 10 million through all the way up to greater than 250 million. And of course, there is a not applicable option. So please press the whatever answer is applicable to you. And
so Vanessa, while the audience is doing that, there are some of you that have asked to download the slides. There's also a green folder widget at the bottom of your screen. You may download the slides there.
All right, hopefully we've gotten everybody to answer that question. I'm going to push out the results now. Okay, so what is our sweet spot today? It looks like we've got 23.6% from greater than 250 million and 25% from greater than 10 million but less than 50 million. Thanks so much. It's really helpful to get that feedback, and we welcome all credit unions on these training webinars. All right, with no further ado, I'm going to turn it over to Judy Graham to tell us about Bank Secrecy Act compliance. Judy.
Thank you, Vanessa, and good afternoon, everyone. As Vanessa noted, I will be briefly discussing the requirements for a Bank Secrecy Act compliance program. I'm also going to talk about the most common violations that are cited during examinations and the steps that you can take to make sure your credit union is in compliance with these regulations. The Federal Credit Union Act requires NCUA to conduct a review of the Bank Secrecy Act compliance program at each examination of a federally insured credit union. Now, Part 748.2 of NCUA's rules and regulations sets forth the requirements for credit unions to establish a written, board-approved BSA compliance program that includes the following. Your program must establish a system of internal controls to ensure ongoing BSA compliance. It must provide for independent testing for your BSA compliance program by the credit union or an outside party. Your credit union must designate a BSA compliance officer responsible for monitoring day-to-day compliance. You must establish a BSA training program for appropriate employees and volunteers, and you also must establish a customer identification program. Now, I say customer identification program here because that's what the regulation says. However, this is more commonly referred to in the credit union world as a member identification program. Now, for the common violations, the first area that I'm going to talk about is the information sharing provision of the Bank Secrecy Act, or what is probably more commonly known to you folks out there are the FinCEN 314A lists. Now, Section 314A of the USA Patriot Act enables federal, state, or local law enforcement agencies to reach out to financial institutions to locate accounts and transactions of persons or entities that may be involved in terrorism or money laundering activities. Law enforcement reaches out to the financial institutions through FinCEN. Now, FinCEN receives these requests from law enforcement and upon review sends an email notification to the credit union's designated point of contact that new information is available through a secure internet website known as the Secured Information Sharing System, or SISS. And this notification is sent out to the credit unions generally every 2 weeks. Credit unions must search their records for data matches, including accounts maintained by the named subject during the preceding 12 months and transactions conducted within the last 6 months. Credit unions generally have 14 days from the posting date of the request to respond with any positive matches. And please note, I did say generally in front of some of these time frames because those are what are included in the general instructions from FinCEN. However, there are circumstances and there have been times where the time frame varies due to special requests by law enforcement. So please make sure that you read those email notifications that come out from FinCEN, because in the body of that notification it will give you the time frames that apply to that particular notification. Now, credit unions should establish proper procedures to ensure that the lists are checked in a timely manner and within the time frame requested by FinCEN. Credit unions must maintain documentation that all required searches were performed. Credit unions should also maintain some type of documentation to prove that they've checked the list as required. The SISS provides an activity report that credit unions may download, and this activity report displays the date the email notifications were sent to a point of contact at the credit union, and also displays the date and time the credit union's point of contact accessed the SISS to retrieve those lists. Now, credit unions may designate up to 4 points of contact to receive the email notifications from FinCEN and access the 314A list on the SISS. Any updates or changes to the point of contact information must be made through Credit Union Online on NCUA's website. Now, I just want to note here that the 314A list that I'm talking about should not be confused with the OFAC list. These are two distinct and separate lists. The 314A lists are requests from law enforcement for information that's related to ongoing money laundering or terrorist investigations. And the OFAC lists enforce economic and trade sanctions based on U.S. foreign policy and national security goals against targeted individuals and entities such as foreign countries, regimes, terrorists, international narcotics traffickers, and those engaged in certain activities such as the proliferation of weapons of mass destruction or transnational organized crime. Now, the next area that I'm going to talk about is training, and as I noted in the BSA program requirements, credit unions must ensure that appropriate personnel and volunteers are trained in applicable aspects of the Bank Secrecy Act. Now, this training should be ongoing and incorporate current developments and changes and new developments in the Bank Secrecy Act and any related regulations. Changes to the credit union's internal policies, procedures, processes, and monitoring systems should also be covered during training. And the training should also be tailored to the person's specific responsibilities. In addition, an overview of the Bank Secrecy Act requirements typically should be given to new staff during employee orientation. The Board of Directors and the Supervisory Committee should be informed of changes and new developments in the Bank Secrecy Act, its implementing regulations and directives, and NCUA's regulations. While the Board of Directors and the Supervisory Committee may not require the same degree of training as credit union personnel, they need to understand the importance of Bank Secrecy Act regulatory requirements, the ramifications of non-compliance with the Bank Secrecy Act, and the risks that are posed to the credit union. Without a general understanding of the Bank Secrecy Act, the Board of Directors cannot adequately provide Bank Secrecy Act oversight. They can't adequately approve Bank Secrecy Act policies, procedures, and processes, or provide sufficient Bank Secrecy Act resources. And similarly, the Supervisory Committee should receive the same training as the Board of Directors to be able to fulfill its function. Now, credit unions should document their training programs, and now how that documentation is done is up to each credit union based upon their training. There may be testing materials if you're providing online training. There may be a sign-in log at an employee training day or some type of certificate in the employee's personnel file. It really depends on how each particular credit union wants to document the training. But the training, the testing materials, the dates of training sessions, and attendance records should be maintained by the credit union and be available to the examiners for review. Now, for internal controls, the same risk management principles that the credit union uses in traditional operation areas should also be applied to assessing and managing the Bank Secrecy Act risk. A well-developed risk assessment assists the credit union in identifying their Bank Secrecy Act risk profile. And understanding the risk profile enables the credit union to apply appropriate risk management processes to their BSA compliance program to mitigate the risk. Now, an effective BSA compliance program controls the risks associated with the credit union's products, services, their members, and geographic location. And therefore, an effective risk assessment should be an ongoing process and not a one-time exercise. Management should update its risk assessment to identify any changes in the credit union's risk profile as necessary. For example, when new products and services are introduced, or existing products and services change, or higher risk members open and close accounts, or the credit union expands its field of membership, or the credit union expands through taking in mergers of other credit unions. Any of these activities could change the risk profile of the credit union dramatically, and that is why we expect the risk assessments to be reviewed and updated on an ongoing basis. Now, suspicious activity monitoring and reporting are very critical internal controls. Proper monitoring and reporting processes are essential to ensuring that the credit union has an adequate and effective BSA compliance program. Now, the sophistication of the monitoring system should be dictated by the credit union's risk profile, with particular emphasis on the composition of higher risk products, services, members, and the geographic locations of the credit union and the geographic locations where the members are also located. As with updating the risk assessment, credit unions should ensure that suspicious activity monitoring systems are reviewed and updated as the credit union's risk profile changes. For example, again, when new products and services are introduced, or when existing products and services change, or higher risk members open or close accounts, or again, as we talked about before, as the credit union expands through expanding its field of membership or through taking in mergers of other credit unions, the suspicious activity monitoring system should be looked at to ensure that it is adequate to cover the requirements. Examiners will review the credit union's transaction monitoring reports to determine whether the reports capture all areas that pose money laundering and terrorist financing risks. The independent testing should be risk-based and evaluate the quality of risk management for all credit union operations and departments. Risk-based independent programs vary depending on the credit union's size, complexity, scope of activities, risk profile, quality of control functions, geographic diversity, and use of technology. So an effective risk-based testing program covers all of the credit union's operations and all of these areas that I just mentioned. And while the frequency of the independent testing is not specifically defined in the statute, a sound practice is for the credit union to conduct independent testing generally every 12 to 18 months, commensurate with the Bank Secrecy Act risk profile of the credit union. Credit unions may have their independent testing conducted by an internal audit department, or it may be an outside auditor or consultant or other qualified independent party. For credit unions who do not employ outside auditors or consultants or have internal audit departments, they can comply with the independent testing requirements by using qualified persons who are not involved in the function being tested. Credit unions that do employ outside auditors or consultants should ensure that qualified persons doing the Bank Secrecy Act testing are not involved in other BSA functions, such as training or developing policies and procedures that may represent a conflict of interest or lack of independence. Now, that was a very brief overview of some of the steps credit unions can take to ensure compliance with the Bank Secrecy Act requirements. For more in-depth information, there are a number of resources available to credit unions. The BSA exam resources page on NCUA's website includes links to the resources listed, as well as some other resources too. We have the Examiner's Guide, the ARIES BSA questionnaire that our examiners use during the examination. There's the Compliance Self-Assessment Guide. We also have the Interagency Statement on Enforcement. Also included in the resources is the FFIEC BSA Anti-Money Laundering Examination Manual. And also, I'll include it on this slide and also on our resources page, is the web address for the FinCEN, which is the Financial Crimes Enforcement Network, who is the administrator of the Bank Secrecy Act. And FinCEN issues regulations and interpretive guidance, all of which can be found on FinCEN's website, and it is a great resource for any BSA-related questions. This slide includes my contact information, and with that, I will turn it back over to Vanessa.
Thank you so much, Judy. Great information, and I'm particularly glad that we have included the BSA resource page from NCUA's website. If you look again in your resources widget, you'll find a direct link to that site. We have heard, and even I have experienced, that finding things on our website can be a little difficult sometimes. So we've given you that direct link, and there's a document you can download under the Resources tab that includes the bios and direct links in a Microsoft Word document. So please use those. Judy, before we move on, I just want to throw out one question that I saw come through a couple of times. Can you tell us, seems like credit unions are saying, well, how do you know which staff should be trained on BSA?
Well, the regulation says all appropriate staff, and that is a great question, and we do get that question quite a bit. And it's really any staff that is, their function has anything to do with anything that could involve BSA compliance. So, you know, really, I mean, obviously your tellers, your member service representatives, lending, your wire transfer people, any of those offices, and would certainly want to receive training. you know, we've had questions about, well, what about our janitorial staff? More than likely, I would say no, unless they are involved in some type of work that would involve BSA, and that probably not. So again, the credit unions really need to look at the duties and the functions of each of their staff and their divisions and make that determination whether training should be provided for that staff.
Fantastic. Thanks so much, Judy. All right, let's move on. And actually, we have our first poll, and it's about BSA. So here the question is, in hearing what Judy talked about and what are the components of a good program, think about your credit union. And, you know, your names aren't along with this, so we don't know what answers you're giving, but we at OSCUI want to get a sense of where is your BSA compliance area weakest. If, as we get this information, we get a sense of where might we help to design more material, more information that can help you. So thinking about your BSA program, is it weakest in training for staff, training for volunteers, internal controls, or independent testing? And again, if you're not with a credit union, you have NA. So think about that. Give us one answer for the area that's weakest, and we'll check out the results.
And we have quite a few questions for your BSA presentation, Judy, so stay on the line. We're going to love to give them to you.
All right, I'm pushing out those results right now. Training for volunteers seems to be the weakest area. 33% responded that way. And then next would be the internal controls at about 18%, and then training for staff at about 16.6. So I'm going to throw out here, because Judy has been on this webinar before, and I remember one of the questions that came up was, hey, can this training that NCUA is giving, can this be our BSA training? Judy, do you want to answer that?
Sure, I'll take that question. This training can certainly be a part of the BSA training, but it would not satisfy the entire training requirement. We're only talking about a very small segment of the BSA today. And we're not covering all aspects of the Bank Secrecy Act and all of the requirements. And not only that, as I said when I was talking about training, the training should also include the credit union policies and procedures regarding Bank Secrecy Act, so that all of your employees and staff know what the credit union's policies and procedures are, and what the procedures would be if they would notice some type of suspicious activity, and who they should notify, or what the process is to make sure that the information gets to the proper compliance officer, to ensure that the situation is investigated and determination is made as to whether a SAR should be filed. Also, policies and procedures regarding any record-keeping requirements, and any policies and procedures regarding CTR filing also, as to, is the teller responsible for that, or does that go to the head teller, or is that responsibility fall on to, you know, the compliance officer? All of those policies and procedures also must be included in the credit union training.
Thank you, Judy. All right, I'm not going to ask you any more questions, because we're going to save those for Catherine at the end. But thank you. That's very helpful. I wanted to address that, particularly because of the results we got. So let's continue moving on. And next, we are going to hear from Galen Wilkins. Galen.
Hey, thank you, Vanessa. Hello, everyone. Today I'm going to talk about adverse action notices and electronic loan payments. I'm also going to include some common errors we find when reviewing loan programs relative to these two topics. Credit union staff who process loan applications should be familiar with adverse action notices, or as the regulation calls them, notice of action taken with a statement of reason. These are the 5 topics I'm going to cover today. Regulation B, implementing the Equal Credit Opportunity Act, defines adverse actions and related notices. First of all, the definition of an adverse action includes more than just denying a loan application. You could review an individual's line of credit and decide to reduce that credit limit. Think about a credit card. And then in the third scenario, you could deny a request to increase a credit limit of an existing loan account. Now in the next slide, I'll discuss 5 scenarios that are not considered adverse action. In those scenarios, adverse action notification is not required. For example, in the first situation, your borrower agrees to have their credit limit reduced, or you close their account due to inactivity. A transaction fails at an ATM, or you deny an application submitted by a minor. And finally, you offer mortgage refinances and someone requests a home purchase loan. In these situations, you do not need to provide notification of adverse action. Well, when are you required to send the notices? In the first situation, you have up to 30 days to review and decision a completed application and send a notice if you deny their request. If it is your practice to formally deny incomplete applications, you have 30 days from the time you deny that application to send out the notification. And we discussed an adverse action is when you might reduce a credit limit on an existing account. Well, you have 30 days from when you reduce the limit to provide the notification to the account holder. And finally, if your applicant does not accept your counteroffer, you have up to 90 days to provide them with an adverse action notice. Regulation B requires at least 5 sections be included in the actual notification. The reg does not require sections to be in a specific order, only that information be on the notice. Also, you're not required to use a specific form, but the regulation does provide model forms you can use, so why not use them? In Section 1 is where you tell the person what action you're taking. For example, you're going to deny their loan application or you're reducing their credit limit. In Section 2, you must provide the credit union's name and address. In Section 3, there's standard language you can find on the model forms and in the regulation. In this section, you're stating you will not discriminate based on any of the prohibited bases, such as race and ethnicity. And in Section 4 is where you provide the name and address for NCUA. The regulation specifically states the actual address used on the form. I have a slide coming up showing that NCUA address that you should use. And in the 5th section is where you provide the applicant with the reasons why you're taking your action. For example, you're denying the loan application because their debt-to-income ratio is higher than your policy allows. However, if you don't provide the reasons in writing on the notice at this time, you must provide the applicant with a disclosure stating that they have the right to receive the reasons in writing and upon their request. Now that I discussed some of the features of the adverse action and the related notifications, I want to talk to you about some common errors that I find when reviewing loan files. Sometimes notifications do not provide a specific reason why an application was denied. For example, we see as a reason outside loan policy, but according to the regulation, that reason is not specific enough. An example of a specific reason could be insufficient income for the type of credit requested. Other times, we see too many reasons why credit was denied. You should limit the number of reasons you're going to state on the notification to your top 4 reasons. It will help the applicant to zero in on what they need to fix in order to gain approval the next time they apply. And lastly, when we compare loan files to adverse action notices, we find the reasons written on the notice do not match the reasons written in the loan file. Another area where we find common errors is during loan file reviews. From time to time, we have found applicants who did not receive an adverse action notice, but they should have. This error is typically found because credit union staff do not understand the definition of a withdrawn application or when a credit union made a counteroffer. First of all, we'll talk about withdrawn applications. Credit union receives an application, and during the underwriting phase, the applicant contacts the credit union and states either verbally or in writing they do not wish to proceed with their request. However, sometimes during the underwriting phase, there is communication between the applicant and credit union staff. It could be either with a loan officer or a loan processor, or maybe even a teller. During this communication, someone from the credit union provided information to the applicant, implying or suggesting the application will not be approved or requested. When an applicant receives some information indicating a negative decision is likely, and then the applicant states they want to withdraw their application, the credit union should consider the application as denied and provide an adverse action notice to the applicant. In other words, if you start asking an applicant if they have additional income or perhaps they need a cosigner, you are effectively denying their application as they submitted it. You need to provide them with an adverse action notice. Okay, now on the next slide, we'll talk about counteroffers. We all know that the simplest two things we can do with an application is either to approve it or we can deny it. Frequently, we see oral counteroffers taking place between the credit union and the applicant, and the counteroffer is accepted. However, when the counteroffer is not accepted, at times we see in loan files the application is treated as a loan approved, but not accepted by the applicant. An approved loan does not meet the requirements of needing an adverse action notice. However, a rejection of a counteroffer requires you to send notification. Another very common error is the notice does not reflect the current NCUA address. Just last year, I saw notices having NCUA's Region 6 name with its California address. That happened a long time ago. And I've also seen other regulators listed on the form, such as FDIC and their address. Now, in summary, make sure your reasons are specific and no more than 4. Your reason for denial matches the information in the loan file and on the notification, and that the NCUA address is correct on the form. And now we have poll 3.
Thank you so much, Galen. Good information. Okay, let's move on to our next poll. And this is a similar question. Thinking about what Galen has told you, which of your adverse action notice sections needs review? Is it the statement of action taken? Is it the name and address of the creditor? Is it the provision of Section 701 about not discriminating? Is it the NCUA contact info? It's very interesting that she saw Region 6. I think we only have 5 regions now, but again, some credit unions just haven't been updating their information. And NCUA's Office of Consumer Compliance is a fairly new office, so that may be another reason. Or is it the specific reason or disclosure of right requirement? So choose one of those. Let us know where maybe we need to help you get a little more training or assistance in that area. Remember, as we're having people answer this, that you can submit questions throughout. I think we're getting quite a few, but there can never be too many because remember, whatever we can't cover during the live session today, we will answer afterward, and that log of questions and answers will be loaded in the archive when we load the archive in a couple of weeks. Okay, let's look at the results here. It looks like the area that got the most was the specific reason or disclosure of right. I thought that might be the case because I thought Galen gave a really good example of essentially you've got to be very specific about that. Try to give the person enough information so that they can address that and when they apply again, be approved. So thanks again, Galen, and we're going to get right back to you. All yours.
Okay. Thank you, Vanessa. Next, I'm going to talk about electronic fund transfers, also referred to as EFTs. Now, you know your members have several options for making loan payments. They can do it by cash or check, and they can transfer money from one account to another, either within your credit union or an external financial institution. These are EFTs. And these are the three topics I'll cover next. Specific requirements pertaining to EFTs are found in Regulation E, and we will discuss the definition of an EFT and also a pre-authorized EFT. We will also discuss how credit unions can encourage their applicants to establish pre-authorized EFTs for specifically making loan payments. Members use various sources and services to transfer their money to different accounts to make deposits, withdrawals, and loan payments. These EFTs can include using point-of-sale transfers, ATM transfers, direct deposits or withdrawals of funds, transfers initiated by telephone, and also transfers resulting from debit card transactions. And it can be whether or not those transactions are initiated through an electronic terminal. So what is a pre-authorized electronic fund transfer? Well, for example, is the ability to set up loan payments in advance so they will be automatically made and recurring. This simplified process of making loan payments will make it easier on borrowers to ensure their payments are applied to their loan as they agreed, and it increases the likelihood the debt will be paid timely and thereby reducing delinquency. However, credit unions cannot require applicants to set up pre-authorized EFTs as a condition for granting their loan request. You can, however, offer a reduced annual percentage rate or other cost-related incentive if the borrower agrees to sign up for the pre-authorized EFT. It is important to understand here, it's very important, you can offer a rate reduction, but you cannot tell the borrower they cannot have the loan if they do not sign up for automatic payments. For example, think payroll. You want to receive your loan payments through payroll deductions, but you cannot require the borrower to do that. Well, of course, there is an exception, and you can find out more details on this exception for an overdraft credit plan by going to Regulation E. For the purpose of my discussion today is not to talk about or include this exception, but about requiring applicants to obtain pre-authorized EFTs for loan payments on other loan products such as signature or automobile. So what are the common errors? It is common to see where credit unions started off with offering an interest rate reduction as an incentive to applicants to sign up for payroll deduction. However, over time, and sometimes changing of personnel, the incentive turns into staff telling applicants they must sign up for payroll deductions in order to receive the loan. Bottom line, credit unions cannot require applicants to make payroll deductions for loan payments as a basis for granting the loan. Now, in summary, you cannot require loan applicants to sign up for payroll deductions or pre-authorized electronic transfers in order for them to receive the loan. However, you can offer them an incentive to do so, such as an interest rate reduction. If you have any questions concerning the information or the topics I discussed with you today, please feel free to contact the Office of Consumer Protection. Thank you very much. And Vanessa?
Thanks, Galen. Great information. I'm going to leave that slide up on there for a moment. Now, remember, though, all of these slides are available. After today, we are going to have the archive, but it's posted about 3 to 4 weeks forward, so it's a good idea to download anything you want from these widgets today, including the slides, because that can also help you with the quiz. All right, let's move forward. And we've got one more, we've got another poll here. So the question is, does your credit union offer an EFT incentive? Galen talked about how you cannot require that they use electronic funds transfer, but you can offer an incentive. So let us know, is that yes, no, or not applicable? And we've still got quite a few questions coming in. That's good. Keep them coming.
We do. We have a lot of questions coming in. So, Galen, you've got your hands full, too.
Okay.
All right. Well, now this is interesting. I'm a little surprised at these results. It looks like yes is 37.6%, but no is 52.3%. Now, my first thought is that maybe a lot of folks don't offer this because they don't have essentially ACH authority at their credit union, so maybe that's the reason. But anyway, something to think about. Very interesting. Okay, let's continue moving on. And now I'm going to turn it over to Andre Lucas.
Thank you, Vanessa, and good afternoon, everyone. I'm going to spend just a little bit of time talking about suspicious activity reports, also referred to as SAR filing, and then I'm going to discuss a little bit about money laundering. But for starters, let me talk about an area that is sometimes overlooked in credit unions, and that is written definitive SAR filing procedures. And it is critical. What you have on the slide that you're looking at now, and this is a checklist of what you should consider when putting your procedures together for SAR filing, starting with identifying unusual activity, going through law enforcement inquiries, you got your national security letters, transaction monitoring, SAR decision making, all the way down to prohibition of SAR disclosure. So you want to consider all these elements when you're looking at putting your written procedures together, and they should be rather definitive when you do that. Now, going forward, when you're talking about some of the basics of SAR filing, there should be a reporting chain in your credit union, unless some of your smaller credit unions, there is one person that does basically everything, so they're doing the monitoring, they're making the decision to file a SAR. But if that's not the case on a larger scale, you should have a reporting chain to when suspicious activity is identified. Who do you report this to? And that should be somebody that would conduct the investigation. And once they conduct the investigation, if the activity is determined to be suspicious, they then at that point have 30 days to file a SAR, keeping in mind that SAR filing is electronic at this point. If you cannot identify the individual, you can get an additional 30 days to identify the suspect. And once a SAR has been filed, that account or individual should be placed on a high-risk watch list for continued monitoring or extended monitoring. Because if the activity continues, that suspicious activity continues, after 90 days, at the end of that period, you have another 30 days to file what's called a continued SAR. And you have to continue filing these SARs at the end of each 90 days if the activity continues. You want to make sure you retain your supporting documents for at least 5 years. Everything under the BSA as far as record retention requirements is 5 years. Also understand SAR filings are confidential. It cannot, under no circumstances, the individual that's involved in the SAR filing should know that a SAR has been filed. And a summary of your SAR filings should be reported to your board of directors on a monthly basis. Now, when making the decision to file a SAR, you've heard over this entire presentation, the word training is critical. Your staff must be trained when it comes to knowing how to file a SAR and what needs to be done with filing a SAR. Starting with your monitoring system and focusing on transaction monitoring. What are they looking for? How are they looking for things? What type of system do you have? And then also your SAR filing guidelines. There are a number of guidelines when it comes to filing a SAR. Remember, too, some of your transactions, they can be legitimate. So an investigation is important to make sure that when you are filing a SAR, you're filing a SAR on the information that is suspicious. So that initial detection, which means after the investigation, you determine this activity is suspicious. Okay, now it's time for me to file a SAR. I've got 30 days to do so. Because sometimes, for example, I know myself, I can't speak for everybody, but if I'm selling a car and I'm selling it to somebody I don't know, I'm going to want cash. So if I all of a sudden walk into my credit union, I'm depositing $9,250 in cash, that may seem suspicious, but in all reality, that is a legitimate transaction. So how do you find out what that transaction was all about? And one thing about filing SAR, there are thresholds that have been put in place to where it is mandatory that you file a SAR. If there's any type of insider abuse, employee, exec team, board of directors, if there's any suspicious activity conducted by any one of these individuals, then no matter what the amount is, you will have to file a SAR. Now, the transactions aggregate $5,000 or more, and it involves money laundering or violations of the BSA, which like structuring, breaking up the deposit to avoid the CTR filing, then you would have to file a SAR once it reaches the $5,000 threshold. If it's a known suspect, someone that you're aware of and you can identify, and it's criminal violations, gun running, drug running, you would then file a SAR also if it's $5,000 or more. And if you cannot identify the individual, that threshold goes to $25,000. Now, these thresholds are set to where it's mandatory you file a SAR. However, you can file a SAR for a lesser amount if you feel that this is something that the federal government needs to pay attention to. I want somebody to take a look at this because the activity is suspicious, and I do believe it may involve some criminal activity. So, yes, you can file a SAR for a lesser amount if you feel that the activity should be looked at. Now, let's talk about a SAR narrative. SAR narratives, they can be somewhat confusing. There have been a lot of discussion about how a narrative should be written, but there are three parts to a narrative, starting with the introduction. When you look at writing a narrative, your introduction should include why is the SAR being filed? What is the purpose? What is the description of the violation? Is it structuring? Okay, is it criminal activity? You know, the date that if there were any previously filed SARs, and if there are any OFAC sanctions involved. Also, what red flags sort of triggered you to feel that you needed to file this SAR? That's just your introduction. And when you get into the body of your SAR, this is the second part. You've got a body, and that's where you're going to put all of your pertinent information, facts about the individuals that were involved, what type of transactions took place, where did they occur, the type of transaction, how did the activity occur? Was it a wire transfer, cash brought into the branch, online transactions? This is where you're going to get into a lot of detailed information to tell you this is what took place, this is why this activity is suspicious, and this is why I'm filing this SAR. Then you're going to go ahead and bring in your conclusion. Your conclusion is going to be a summary. All right, it's going to. What are you going to do next? Are you going to continue monitoring the account? Are you going to close the account? Is there anyone else in the credit union that has information that can be contacted? Was any law enforcement involved? Just a conclusion, giving a little more information to where if they need to contact you, where can they get more information from? I mentioned earlier that SAR filings are confidential. You cannot disclose the information that a SAR has been filed. Can SARs be shared? Absolutely. There are certain situations where you might share a SAR with an examiner or an auditor. Even some boards like to look at SARs. The main thing is you have to make sure that whoever the SAR was filed on, whoever's involved in the SAR filing, they cannot know that a SAR has been filed. If that information is disclosed, then that is a severe violation. Here's an example for you. Frank Mendoza reported a SAR in November 2008. It was a mortgage loan fraud. And what he was trying to do was get the individual to pay him to monitor the investigation and help the guy stay ahead of the federal government. Well, it turns out that this individual, the borrower, reported Mendoza to the federal government. Mendoza was arrested and fined $25,000 civil money penalty. And when this case was first aired, Mendoza was facing a possible 95 years in jail. So do not disclose the filing of a SAR in any case. Let's move ahead and talk just a little bit about money laundering. Very simple. And I'm going to give you some simple information on money laundering. Money laundering is criminal finance. Anytime you know that the money is illegal, it came from an illegal source, and you're doing anything to try to conceal where it came from, that is considered money laundering. You want to deposit the money and have the source of it completely disappear, where it cannot be located. Most common perception of money laundering, you're talking about drug trafficking, tax evasion, terrorist activity, but these are just the common ones. There are a number of other criminal violations involving money that can be considered money laundering, but these are the most common sources of money laundering. Whenever somebody mentions money laundering, this is what they think about. Most basic strategies when it comes to money laundering, deposit into financial institutions. Keep one thing in mind. You cannot launder money unless it is deposited into the financial institution. And that's done through wire transfers, business fronts, fictitious identities, offshore transactions. No, it does not include putting money under your mattress. You cannot launder it. You cannot launder by burying it into the ground. you must deposit the funds into the financial services industry for it to be laundered. That's the only way the source is going to be covered up and disappear. 3 stages. Number 1 is placement. I'll give you an example. Got a team of guys working together selling drugs, guns, or whatever they're selling. Each one of them will open up 10 separate bank accounts or credit union accounts. So you wind up with 30 accounts. Once they've got all their funds together, they will all visit each one of these locations and deposit uneven dollar amounts, less than $5,000, say $2,375.18, and so forth and so on. Within a matter of a few days, most of these transactions will go unnoticed. They will not raise any red flags in your credit union. But over a matter of 3 days, they may have deposited over $200,000 into the financial services industry. The next step from that point will be layering. They will then transfer these funds into 1 or 2 accounts, and they'll do it by means of wire transfers, ATM transactions, electronic funds transfers, checks, however they can move the funds into 1 or 2 institutions. So they've layered all this money into 1 or maybe 2 institutions. The final stage is integration, where they'll take those funds and they will invest those funds into maybe property or some type of business. They may purchase virtual currency, it's like Bitcoin or what have you. But by that point, the source where those funds came from has disappeared. So it's hard to trace it. It's hard to go back and find out where it came from. So that means, say, for example, if somebody walked into the credit union, they now have $200,000 in the savings account. They want a share secured loan. When they walk out of there with that check, they now have clean money, and they'll take that check and make a down payment on a home, maybe a $400,000 home. They put $200,000 down on the home. Nobody's going to turn down that loan. By that point, the trail has grown colder. Okay, so that is it for me today. And this next slide here is my contact information. If you feel you need to contact me, please feel free to do so. Vanessa, back to you, and thank you very much.
Fantastic, Andre. Thank you so much. I want to say that most of the NCUA staff, the full staff, went through a week-long training a couple of weeks ago, and we had a presenter from the FBI come in to talk about money laundering, BSA, and he said that it is the reports that they get from the financial institutions, banks and credit unions, that are the key pieces they use in order to trap these money launderers and other, folks who are doing bad things with money. So it's really important to know about your suspicious activity reports and to really, just have a process in place and have your procedures in place, as Andre talked about. So thank you, Andre. Fantastic information. On the next slide, we're going to talk about the certificate again. So remember, in the magenta widget, it should actually give you a little report as to how close you are to achieving the certificate. And in the right magenta widget is the actual quiz, which you maybe have started, but we'll actually leave the webinar open even after the Q&A, so you'll have time to do the quiz if you don't want to get distracted with that right now, but I just want you to know where they are. So please do work on getting that certificate. Okay, so next, I promised a couple of minutes on the CDFI Fund. So what's exciting and sort of new news is that NCUA is partnering with Treasury's Community Development Financial Institutions Fund. The CDFI Fund is an agency within Treasury that both certifies financial institutions as being essentially committed to serving the underserved, community development financial institutions. In addition to that certification, that stamp of approval, yes, you meet that, our definition of a CDFI, it also provides financing. Every year there's a CDFI program round where credit unions and other financial institutions can get up to $2 million to support their business plan. So what's this new partnership? Essentially, NCUA and the CDFI Fund have agreed that credit unions, because they're already regulated financial institutions, we actually already get a lot of data through the 5300 report that will help to prove to the CDFI Fund that they meet most of the certification criteria. So what this handshake says is the CDFI Fund will now accept that data as at least partial proof that the credit unions can now be CDFI certified. So it's easing the process for credit unions to be CDFI certified. We're very excited about it. It's in process now. And, again, for those credit unions that are truly serving the underserved, I think you'll want to learn more about this. On that note, we have a 2.5-minute video that we'd like to show. It's essentially a snippet from a video series that we created all about CDFI certification and why you might want to pursue it. So I'm going to click next, and the video should start on your screen. Give it 1 second here. All right, I'm going to ask On24 to help us out with playing that video clip. Are they still with us, On24? Yeah. Great. There it goes. I see it coming up now.
It was the best of times.
To watch these people move out of being homeless and transitioning to having their own homes, it's a good feeling that you get from it.
It was the worst of times.
We were in a state of turmoil. When our plan sponsor shut their doors without warning and laid off over 500 people.
It was the age of wisdom.
Applying for the certification really was more about what if we didn't take on this certification, and what resources would we be missing out on if we didn't try.
And the spring of hope.
The greatest benefit is seeing 3 generations change. That, to me, is the heart of credit unions.
This is the tale of 3 credit unions and their CDFI story, the Community Development Financial Institutions Fund. Ginette Gibbs knows firsthand the value of CDFI funding. It was a lifesaver when her credit union's biggest sponsor shut down with no notice, but her credit union board said no way.
Our board was already looking for innovation and expansion. It wasn't a need to convince. It was more an opportunity of seeing an alternative to not surviving. And so CDFI was a way for us to expand into areas that would ensure our survivability.
New Horizons Federal Credit Union has received CDFI funding 3 times since 2002. With the goal of helping those who could not help themselves in the tiny coastal community of Hoquiam, Washington. The help included assisting a growing Hispanic population and others who were chronically under or unemployed.
Providing loans to people that with their credit scores would never be something that you could provide a loan to because they were far too risky. Those things together meant that we could make a real impact in our community to make people more financially viable, better employees, and we worked with small entrepreneurs to actually build a bigger job pool. The pride they have in their, I'm going to get all emotional. The pride they have in themselves changes, and it's contagious.
Okay. So again, that was just a snippet. Again, if you go to the resource tab, there's a direct link to the YouTube site where you can watch all of the snippets, all of the 3 stories that are contained in that video series. So if you're at all interested in becoming a partner with the CDFI Fund, getting certified, and potentially getting that $2 million or some amount of that, please view that video series. All right, so I'm going to now turn it over to Catherine to talk about the Q&A.
Thank you, Vanessa. So I'm going to push out to our audience. This is a survey that we'd like you to fill out for us. So just give it a second to come up. And it should. So while we do the Q&A, we'd like to have you pay attention while we talk to our speakers to discuss some of these wonderful questions that have come in. We have a whole lot of questions, everyone. So we won't get to all of them today. However, we will answer your questions. Fear not. And so, Judy, let me make sure my speakers are. Judy, are you there?
I'm here.
Galen?
Yes, I'm here.
And I see Andre is right beside me, so he can't go anywhere. All right. Since Judy was the first speaker, Judy, let's give you the first question. There are a lot of BSA questions. So one of the things I think that credit unions, we had quite a few questions from small credit unions, and we'll get to those later. But I'm going to give you the first question here, Judy, and it's question number 64. Okay, I'm going to read it for you. It says that you mentioned the person performing the audit shouldn't be doing the training as well because of a conflict of interest. So, and they want to know, can the credit union be cited by their examiner if this is the case? Can you clarify that?
Well, part of the requirement for the independent testing is that the testing be conducted by someone who is independent of the BSA function. So again, if, as I did mention that, yes, if it's someone who has conducted training, they really cannot come back in and provide a completely independent review of the training program at the credit union because they're the one who has conducted it. So the examiners would look at that as not being an independent testing under that particular circumstance.
So there was another question that was along the same line, Judy. It's question 52. So the credit union referred to the BSA officer as conducting the risk assessment. Now, does that need to be conducted by another auditor or employee who is independent from the BSA function?
No, the risk assessment is something totally separate from the independent testing requirement, and the BSA officer can most definitely perform or compile and put together the BSA risk assessment for the credit union.
Okay. So one more question to you, Judy, before we move on to Galen. You're going to be my next person, Galen. So question 54, we got this quite a few times for small credit unions in particular. They want to know if they can get their hands on a template for a risk assessment. Do you know of any?
NCUA does not provide any specific template. Each credit union is expected to do, their risk assessments are all going to be different because the risk for each particular credit union is going to be different. Now, in the FFIEC Bank Secrecy Act Anti-Money Laundering Manual, in one of the appendices, and I don't remember which appendix it is offhand, but I know that we do have an appendix in that manual that does have sort of a guideline of the areas that the credit union can look at, and it's Appendix J, and the credit union can use that as a starting point. What I will say is that we have seen credit unions try to take this appendix and just photocopy it and circle, low, moderate, or high. But what our examiners would expect is some type of a write-up regarding why the credit union feels that different areas would fall into either a low, medium, or high category. So that appendix that is in the manual is a good starting point, but like I said, NCUA doesn't provide any particular template for credit unions for that.
I think Vanessa has something for you, Judy.
Yeah, I'm going to push to audience the materials that are on the BSA exam resource, so that's on our site. And I see something listed as the NCUA Compliance Self-Assessment Guide. So tell us about that, Judy. How might that be helpful?
Well, there's information in the Compliance Self-Assessment Guide regarding Bank Secrecy Act, regarding what the requirements are under the Bank Secrecy Act. There are several reporting requirements and also several record-keeping requirements under the Bank Secrecy Act. And in the Compliance Self-Assessment Guide, it talks about what these different requirements are. So the credit unions can use that as a guide to help them to make sure that they're in compliance with the Bank Secrecy Act. Now, the risk assessment is something a little bit different, where the credit union really needs to look at, their products and services that they're offering, their field of membership, and the different geographic locations that they cover to make a determination as to how that all falls into the risk and what their potential risk could be for being used as a conduit for money laundering activities.
Okay, great. So it sounds like, again, that FFIC BSA AML examination manual, you said Appendix J might be helpful in doing that. Okay, great.
Right,
Thank you, Judy.
right. It is a good starting point, but we also do expect the credit unions to also provide some type of documentation as to why they feel that their risk is high or low when they're looking at different areas.
Wonderful.
Thanks, Judy. We have some more questions for you. I'm going to jump back to you after I get Galen and Andre here. So, Galen, you ready for your question? Your first one.
Certainly.
All
Look forward to it.
Good. This is question number 163. So here's what the credit union said. They said that they don't use credit scores to approve or deny loan requests. So if they deny, do they still need to include a credit score shown on the credit report on the adverse action notice?
Oh, that's a very good question, and we do receive that question frequently when I'm out in the field. And for the credit score, just to be clear, this is falling under the Fair Credit Reporting Act as well, that requires the credit score on the adverse action notice. And we didn't cover that in particular in this webinar. But if you are pulling a credit report at all, you should probably be reporting that information on the adverse action notice. I can provide a more detailed answer in writing if you have other questions you'd like to ask about that.
Okay, great. So here's the next question. This is along the same lines. Question 143. The credit union says, must an adverse action notice be sent if the member doesn't respond one way or the other to a counteroffer?
That is something that is where the confusion and the errors that we find when we're out in the field reviewing the loan file. If you've generated a counteroffer, you have essentially denied the application as you received it, and you're making a counteroffer, and you have not heard from them, yes, you should be providing an adverse action notice based on the terms of their original application.
All right. Now let's try this one, Galen. Okay, this is question 135. You know, the credit union was kind of bummed that they couldn't require electronic funds transfer to pay a payment. But they said, can you require direct deposit?
A direct deposit? You know, I'm not sure that there probably needs to be more to that question because
here's what they're asking, Galen. They're saying that, you know, you mentioned in your presentation that you can't make it a requirement that they have an EFT in order to get a loan, right?
Mm-hmm.
And they said so, but since we can't require that they pay the payment as an EFT, can we require that they at least do direct deposit to get a loan? Did that make sense?
Well, a direct deposit is a deposit into an account such as their share account.
Mm-hmm.
Is then the credit union going to require a transfer from that share account to make the loan payment? And that's the part of the question that I think that's not being asked or needs to be included in that, because you can say you're going to make that deposit, but what about that transfer to make that payment? So in other words, it sounds like they are requiring that transfer.
Okay. Makes sense.
And to close that out, they should not do that, right, Galen? They can't
Very
require
good.
it.
Thank you. Very good.
There you go, just to make that clear.
All righty. So now let's move, Galen, I'm going to bounce back to you in a minute, but I'm going to go to Andre since he's hanging over my shoulder here. So, Andre, here's a question for you. Question number 158. The credit union says, is a SAR filing on cash transactions only?
No, Catherine, it's not just cash transactions. Suspicious activity can involve checks, money orders, wire transfers, credit cards, almost any type of loan that can trigger SAR filing or suspicious activity filing. Fraudulent loans, for example, or a check that's been returned stamped fictitious or fraud altered checks. So no, not just cash only. There are a number of transactions in various forms, even through ATMs, that you will wind up filing a SAR.
Okay, Andre, here's another one, question 153. You talked about notifying the board about a SAR. They said, can you expand on the board notification summary format? What should be in it? We've got a couple of questions like that. So
yes, and Catherine, there's no standard format. In some cases, what does the board want to see? The bottom line is, making sure that you do not violate the prohibition of SAR disclosure. The individual that's involved in the SAR filing cannot know. Now, I always give an example when I'm talking to boards. The BSA officer has to report to the board the number of SARs that were filed within a particular month. And if the board wants to see the SAR and see all the information on who the SAR was filed on, you report that you have 5 SARs that were filed. But when the board wants to see them, you give them 4 SARs to review. And so that basically tells you chances are somebody in that room has a SAR filed on them. So what are you doing? You're increasing your level of risk, which should probably be addressed in your risk assessment. And so what are your chances of violation of the prohibition of SAR disclosure? That's been a question that's been discussed and bounced around for quite a while. How much information do you share? Who can you share a SAR with? FinCEN's stand on this is as long as you do not violate the prohibition of SAR disclosure and the individual that the SAR was filed on does not know that the SAR was filed on any information in that SAR.
Can I just jump in here?
Absolutely.
Also, Andre talked about reporting, the number of SARs. The reason that requirement is out there is because the board is responsible for ensuring the ultimate in establishing proper procedures and controls. So the reason the requirement for reporting SAR information to the board is so that the board understands what type of activities are going through the credit union, and so that they can maybe put in other controls to either stop or at least control or mitigate or monitor the activities that are going through the credit union. So the board should receive enough information to understand what that activity is. Now, whether it's the compliance officer reporting that we filed a total of 10 SARs this month. 5 of them had to do with structuring, and 3 of them had to do with, suspicious wire transfers, and the other 2 had something to do with either check kiting or what have you. So the board also has to receive enough information so that they understand what the type of activity is that's going on through the credit union.
Thank you, Judy. I'm going to give Andre another question, and then, Judy, I'm going to bounce back to you. Andre, this is a question on that 90-day period. Question number 147. The credit union says, does the 90-day investigation period for filing continual reports go on indefinitely for the life of the account?
No, in most cases, the credit union will eventually close the account, but it's recommended that you actually contact FinCEN first in case there is an investigation on that account. You don't want to just shut the account down. But now you can, at some point, close the account. You will probably receive a notice asking you to keep the account open not to exceed 6 months. And then at that point, you can close the account. I don't recommend that you continue filing SARs on an account for the duration of the account. You can, at some point, close the account.
Thank you, Andre. Judy, you ready for you?
And I just wanted to add to that. I mean, if the activity continues, if the activity that caused the original filing of the SAR continues in the account, then that 90-day period continues for as long as that activity continues in the account. And whether, as Andre said, whether the credit union chooses at some point to close out that account, or not is a credit union decision. But as long as that account is open and as long as the activity continues, then that 90-day filing requirement still stands.
All righty. So now, Judy, here's a question for you. This is question number 34. Good question here. Credit union says, what do you consider acceptable documentation for showing compliance with Section 314A requests? That's the first part of the question.
Okay. There is no prescribed document or prescribed set of rules as to what the actual documentation the credit union provides is. That's a credit union decision as to how they want or what they want to do. It could be that they just keep a manual log as to who signed in and what date and when the information was queried and searched through the credit union's records. Like I said, there is now an activity report that's available on the FinCEN site, on the 314A site, that can be downloaded, and the credit unions can use that. So it really depends, and it's really up to the credit union as to what documentation is provided. Now, we have some examiners who, and we kind of preach this in the examination world, a trust but verify. So sometimes examiners may ask for additional information. So that's really going to depend, like I said, on the particular credit union and what's going on at that particular credit union as to what documentation would be acceptable.
Okay. So now we may have asked this question, so stop me, Judy, if I did. But we got this a couple of times too. Questions 42 and 43, the credit unions want to know if the supervisory committee can conduct the BSA independent testing.
The supervisory committee themselves, that's a good question. You're going to have to, the wheels are turning here, so I'm trying to process the whole thing. But I would say more than likely probably not, because it's up to the supervisory committee to make the determination as to whether all of the operations of the credit union are operating in a safe and sound manner. So for them to be reviewing the BSA compliance may not be such a good thing, but I'm going to tell you what. Let me do a little bit of research on that, and can I respond to those questions when we put out the Q&As or the answers to all of the questions and respond to that a little more thoroughly then?
Absolutely, you sure can. So let me throw this question at you then, okay? It's question number 25. So this is apparently a new credit union, and they said, when should they begin their independent testing? They're maybe 4 months old that they went into operations.
Oh, gosh. They should probably have their independent testing completed, I would say, definitely within their first year of operation, because that independent testing would be looking at the controls that they have, the initial controls that have been put into place. And since this is a new credit union, I mean, obviously there are controls. They have to start complying with the Bank Secrecy Act from day one. So there should be testing to ensure that they have the proper controls in place as soon as possible.
Okay. I'm going to jump down to Galen, and then I'm going to hit Andre as time permits because we're just about out of time. But we will have all of these questions answered and online, and the answers will also go to the questioners, all right? So, Galen, you ready?
Yes, I am.
Okay, here's an interesting question. Question number 120. The credit union says, now there's multiple credit unions that are sent a credit application. one credit union makes the loan and the other credit unions who review, do they have to send an adverse action notice? And if no,
okay,
go ahead. Go ahead.
Yeah, this question comes up in the context of indirect lending, where they have a dealer that will receive an application and might send it out then to 2, 3, 4, how many other financial institutions they send an application to. And generally, you do not have to send an adverse action notice if you decide not to accept that loan, which is in effect a denial, if that loan has been approved or accepted by another financial institution. So the question is, how do you know, or how would you be made aware of that? And that would be through your relationship with your dealer to make sure. Now, you have every right to send out an adverse action notice. You don't have to rely on another financial institution to do that, but it's up to you to make that decision whether you want to cover yourself and say you're going to deny it and send out an adverse action notice if you don't have a good enough relationship with your dealer who will tell you it's been approved someplace else.
Okie dokie. So I'm going to give Andre the last question. It's question 181. This is interesting. Credit union says, is a member receiving a fraudulent check for under $5,000 something that should warrant an SAR? And they ask that because they've had several members in the past few weeks who are depositing fraudulent checks, and they're under $5,000. Andre?
Yes, as I had mentioned before, the $5,000 threshold is where it's mandatory to file a SAR. You don't have to have a $5,000 or reach that $5,000 threshold to file a SAR. If you feel that there's activity that's taking place that should receive a SAR filing, absolutely. You can file a SAR. You've got fraudulent checks, and in some cases, if you've got members that are repeating that activity, chances are that it's going to cross the threshold anyway. So I would recommend, yes, if it's fraudulent checks, checks have been altered, fictitious, I would recommend, yes, you do file a SAR because that can be a case of money laundering.
Sounds good to me. Well, ladies and gentlemen, thank you so much. We're fresh out of time. I just want to make a quick announcement. We have a special CDFI certification webinar on June 23rd. It's titled CDFI Certification, More Than One Way to Get There. June 23rd at 2 p.m. Please join us. You won't regret it. We also have an upcoming webinar on May 11th to talk about our 2016 grants. Please join us. You don't want to miss it. I'm Catherine Baxter. We've had a wonderful time with this webinar. Thank you for joining us. Thank our speakers, Judy, Galen, Andre, and Vanessa, my host. We'll see you next time. Have a wonderful evening and a great week.